Hi, this is Drew Erickson back again talking about money, not math, because I believe most people love money without realizing how often it doesn't work the same way as math. And also, I love our country, but I believe our government is terrible at managing money and should not control our financial future, so I hope I can bring you value. All right, so in today's conversation, I'm reviewing an article from MarketWatch.com titled, Here's How a Top Hedge Fund Manager Says Investors Should Prepare for Soberingly Low Returns. And this is published back on February 4th, so about 20 days ago, but I feel like the information is still applicable and hopefully interesting and valuable for you. All right, so it says the threat of the spreading coronavirus has once again grabbed the headlines, with markets reacting to the latest developments. Over the longer term, investment management company AQR said future returns would be soberingly low, and investors would have to choose from an unappetizing menu of low yielding assets. The company, which was co-founded by Cliff Asness, said it expected the real return of the traditional U.S. portfolio, which is known as 60% stocks to 40% bonds, as far as the ratio within a mutual fund, over the next 5 to 10 years to be 2.4%. So to repeat that, the company said it expected the real return of the traditional U.S. portfolio over the next 5 to 10 years to be 2.4% rate of return. This is around half of the long-term average since 1900. AQR said it expected 4% returns for U.S. large equities, while estimates for all assets classes were lower than a year ago. So a couple things to keep in mind here. First, it explains the extreme importance of understanding the difference between historical averages compared to future real return projections, okay, or actual rate of return projections in the future. All right, so that's number one. Remember, there's a very large difference between historical averages and future real or actual rate of returns. So if you're using historical averages to project future returns, you're likely going to be unfortunately surprised in the future. Second, is your financial plan prepared to potentially only receive 2.4% real return over the next 5 to 10 years? Or are you hoping for a lot larger numbers? And third, this is another good example of, are we completely only focusing on rate of return, rate of return, rate of return, how our money is going to grow? Or do we think it may be a good time to start thinking about how are we going to be able to spend our money in retirement? In other words, rate of distribution. All right, so what's more important, how your money grows or how you can use it in retirement, right? So these are all things to make sure you're aware of, especially considering the low projected returns over the next 5 to 10 years. All right, continuing on with the story. The estimates do not want aggressive tactical allocation responses, the hedge fund manager's company said, but it called for investors to reassess their objectives and expectations. As of January 2020, these estimates are soberingly low. They suggest that over the next decade, many investors may struggle to meet return objectives anchored to a rosier past. Low expected cash returns are one clear culprit, dragging down expected. Oh, excuse my alarm. I apologize for that. Anyone who knows me really well is probably laughing because I set a lot of unnecessary alarms. Anyways, back to what I was saying. Sorry. They suggest that over the next decade, many investors may struggle to meet return objectives anchored to a rosier past. Low expected cash returns are one clear culprit, dragging down expected total returns on all risky investments. AQR's capital market assumptions study added, investment objectives may need to be reassessed even if this necessitates higher contribution rates and lower expected payouts. And the case for diversifying away from traditional equity and term premia is arguably stronger than ever. In other words, looking for alternative planning options than just being completely dependent on the stock market is what they said in English words, that's what I'll translate to English is what they just said. So I'll say what they said again, and hopefully it's clear based off what I said. Investment objectives may need to be reassessed. In other words, how are we planning for our investments to grow? And what are our expectations, even if this necessitates higher contribution rates and lower expected payouts. In other words, saving more with lower expectations of growth. All right. And the case for diversifying away from traditional equity, traditional like investments like the stock market, and term premia is arguably stronger than ever. So looking for alternative options. All right. It's a multi-style strategy balancing value, momentum, and defensive styles could achieve a higher return. Among equity styles, defensive and momentum styles are mildly rich by some measures, while value has been looking increasingly cheap, the report authors added. All right, so overall, hopefully this conversation was helpful for you. A few key points to repeat are: first, they project the real return of a traditional U.S. portfolio over the next 5 to 10 years to be 2.4%. So are you planning realistically accordingly for your future? Second, based off of these expectations, are you open-minded to outside options besides just having all your money dependent on the stock market, whether it's through your 401ks, your IRAs, your brokerage accounts, however you're investing? Are you completely dependent on the market with unrealistic expectations, or are you open-minded to other conversations? And third, are you focusing on rate of return, rate of return, rate of return, rate of return, like 95% of all the other people? Or are you aware of how where you put your money today is going to affect how you can use it in retirement? All right, so hopefully this conversation brought you value. Thank you for taking the time to follow along and contribute to the conversation by either reaching out, commenting on my posts, or sharing with a friend if you thought it was valuable. Again, this is Drew Erickson talking about money, not math, because I love our country, but I believe our government is terrible at managing money and should not control your or my financial future. So thanks again for taking the time to contribute or follow along, and I hope you have a great day. Thanks. Bye.